So today's video we're going to be looking at why a 50-year mortgage might cost you hundreds of thousands more. So I came across this news the other day, and I read that they're actually trying to change the loan term from 30 years for a mortgage, from 30 years to 50 years. Okay, so I went in, I'm like, okay, so let's actually just find out what these people are trying to do. Well, I'm coming down to give you guys what I really think is going to be happening if we end up changing the loan term of a mortgage from 30 to 50 years. Okay, my name is Sonia. So imagine yourself, right? Just imagine that you have a home about 300k, okay, and let's just give a little bit of scenario, and the first person has a 30-year, which is going to be, they decided to do 30 years for the same 30k. They're going to be paying something like 1,800 a month in their mortgage. And then the next person decided, oh, I really want a lower payment, so let's just try to extend my loan term. So they did a 50-year, which ends up giving them something like 1,550 a month. Okay, so whoever is taking the 50 years thinks that they will have a saving of about 250 a month, but the thing they didn't put into consideration is how much they're going to be paying for the next 20 years in interest. Okay, so that's how this is actually looking. But without taking much of your time, let's dive into the main topic and break this down. Okay, so like I just said, I do a lot of real estate and finance videos. So if you're coming to this channel and you really haven't been here, then thank you, you're in the right place for any tips on real estate and finance. Okay, so the longer your loan term, the longer the interest you're going to be paying. Okay, so keep that in mind if we end up switching from a 30-year to a 50-year. And I mean, there are gonna be its own advantages, but let's really be realistic on what is actually, or how it's actually going to be affecting us. All right, so before you jump in to actually go in and take this 50-year loan, and in case they get it approved, then make sure you understand that this is going to be draining you in terms of your wealth in the long run, and we are going to be telling you what it is all about. Okay, so what exactly is a 50-year or a 50-year term mortgage? A 50-year term mortgage is just a loan, right, on your home, where borrowers will prefer to pay their loan term within a period of 50 years instead of the normal 30 years or 15 years that we've actually already been having. Okay, and this will they will be able to stretch their payments for a long time. That's 15 years. That's almost half of somebody's life. Okay, a lot of people don't even live up to 100, and even if you live past 100, that's a lot of time for you to be able to pay a mortgage. Okay, so even though you're going to be having a lower monthly payment, which is very good, okay, but the time in depth for you is going to be way much longer than whoever or your counterpart that choosing a 15-year term or a 30-year term for the same amount of home. All right, so like I said, the interest you're going to be paying over the life of that loan, please actually sit down and make your necessary calculations to see how much you're going to be paying, so that you know what you're actually trying to get yourself into. It's not very common in most markets, but they are trying to push it to put it into context, or make us understand that you can actually still go in there for this 50-year term mortgage. Okay, and why would you even think lenders will be willing to offer this long number of years to somebody just trying to basically purchase a house? Well, to make it affordable for people that will love high-end houses, but they can't afford it if they only have 30 years, because with 30 years they're going to be paying a higher mortgage. So if they extend it to 50 years, they can easily qualify, because guess what, their monthly payments are going to be lower, so they're not going to be calculated. Their debt to income ratio is going to be equally lower if they have to stretch it for 50 years. Okay, the second thing, or the second reason why a lender will want to offer this at all is because they want to attract buyers. Like I said, attract buyers to be able to buy these houses are in a high cost market. Okay, and the third thing is the interest they're gonna earn. Remember that when you're paying these loans, you're paying the cost of borrowing. So why won't the lender be happy for someone coming to actually get a 50-year or a term loan, right? That's a lot of interest for them. So I mean, if I were the lender or the bank or the mortgage company, of course I will be happy. I will be making way more money from you than whoever is going to only do it for 30 years. Okay, remember that the way the way a mortgage works, when you initially buy your house, most of your payments go towards your interest and not your principal. Okay, so always keep that in mind, that your payments for the first few years are going to be going, most of them are going to be going towards your interest, because you have to first of all pay the cost of borrowing before you start paying down your interest. So always keep that in mind, because if you know that, you're going to realize that in 50 years you're not going to be able to, in 50 years it's going to take you a long time for you to start realizing that, oh, my principal is going down, I'm actually getting equity in this house. All right, so let's just have a little breakdown on what is really going to be happening if you actually end up with a 50 years loan term. So the first one is going to be a longer loan term. It's, like I said, it's 50 years. That's long enough, more than 30 years, even though it's going to be equal to a lower payment, but you're going to be paying for a while. So imagine you and I choosing the same amount. I choose a 30, you choose a 50. When I'm done, you're still 20 years. You still have 20 years left. So I'm done in 30, you still have 20 years. So I can own my house, I can do what I want, I can resell it. I'm going to be having 100% equity in 30 years, and you are not going to be having 100% equity in 30 years, because you still have 20 years to go on to this loan term. All right, and you will be paying 20 years extra interest. That's money that you could save to invest in something else, money that you could use to maybe buy a second property, okay, or maybe start a business or do something else. That's 20 good years of you being able to pay the bank their interests. All right, so if you want to stay in the interest mode, then you can choose to do the 50-year term mortgage. But if you think that you don't have the kind of patience, money and time to be paying for these long-term mortgages, then you have to rethink your before you actually go in to get this kind of mortgage. All right, so keep in mind that during the first few years, maybe like between even 10 to 15 years, you're not going to even see anything change in your mortgage, because you're still going to be struggling to pay for your interest, right? So your principal looks untouched. If I have 30 years and you have 50 years and I've been paying mine, maybe between 10 to 15 years, I'm going to see a little change, or a greater change as compared to you who only you have 50 years. So if we go into 15 to 20 years, you're still paying high interest. So before you even start looking at how much equity you have in there, your time, I don't know, is almost gone. So please keep that in mind and know that it's gonna take you for a really, really long time. Okay, so let's just have a little example and let's see how these people are going to be paying it. Imagine you have two clients, they come in, one the same amount, they have the same house or almost the same house, and one is willing to to go into a 30-year mortgage for a 300,000 house, and like I said, their monthly payment is going to be something like 1,800, and 50 years is going to be having 1,550. So they think they equally are going to be having a $250 savings a month. And the interest that you're going to be paying over 50 years is going to look something like 270. And how did I get that 270,000? So imagine 30 years interest and the person end up paying something like 350, but whoever is going to be taking that 50 term years, okay, that 50 years term is going to end up paying something like 620 in interest only. That's not even the principal, in interest only. So they end up, so if you minus the 620 minus 350, which is the 30 year, you're going to be having something like 270,000. So let's compare that to, that's how much you're going to be paying to the lender, okay? So let's compare that to the 250 a month that are going to be earning. So if you calculate that $250 a month for the remaining 20 years, which is going to be the additional years are going to be having, that doesn't even add up. It's something like 60,000, okay? So imagine you giving the lender 270 and you only gain 60,000. That's still a difference of 210k. So it's a lot of money. When I say you should have been using the money to invest in something else rather than you going to put this. I mean, I understand that times are hard, things are changing, the market is very hard, houses are expensive as well, but you really want to sit down and take into consideration how this is going to be affecting you in a long run. So let's have a little bit of scenarios here and let's see what, if you choose to take a 50-year loan, how it can affect you, okay? So the first one is someone who actually ends up taking this will have what the thing is the low payment, okay? The low monthly payment, which is for me a trap, okay? So let's take, for example, this family decides to take a 50-year mortgage and they're able to save 260 a month, okay? Then after 10 years, they still owe almost the same principal, okay? They are paying and they will continue paying for the interest and they are not having any equity. And if they decide, oh, I'm tired of, I want to move to another place, they decide to sell that house, they will almost walk away with nothing, because what they weren't paying down their principal, they were paying off the cost of borrowing. So that means they barely have a lot of equity in that house to walk away with. The second scenario is there's gonna be a retirement problem for anybody that decides to. Like I said, we only live for so much long, right? At a certain age, we get tired of working, and most people don't even get to buy a house until maybe in their 25, their 30s, their 40s. So imagine if you are 40 and then you go and choose a 50-year term mortgage. How does that sound? That means you're already 40 years old. By the time you're maybe 65, 70, you should already be tired of working, but you can't stop working because you have a mortgage to pay. And by that time, most people end up with a fixed income. So imagine you having a fixed income plus that mortgage to pay. That means your retirement plan or your retirement time is not going to be what you really dreamed or maybe expect, because that time you should have been done paying off your mortgage if maybe you choose a 15-year or a 30-year, okay? So at least you have some free, you won't have to pay for a mortgage. That means money that you would have been keeping aside for that, you will use it for yourself, you know, maybe have some vacations or just enjoy the remaining time of your life. The third one is going to be the market drop scenario. So imagine you get into this 50-year-old term mortgage and the home prices fall from, let's say, 5 to 10%, is going to be a very risky investment for you. It's going to be very risky because guess what? Like I said, you're not surely even going to have enough equity to even sell out if you're going to be leaving. Okay, so the principal has barely moved. You still have a lot of principal to pay plus the interest, so it's risky. It's very risky. And I understand that. I mean, some people might think it's going to be a better way renting for them during this time than to rush in, and I equally think so. Than to rush into this long-term loan, it's better to rent for some time, then prepare. Maybe you save up enough so you can pay down any credit cards or any other loans you already have. That way you can qualify for maybe a 15 or a 30 year when they do your debt to income ratio. Okay, and we are done talking about all the things that a 50-year can do. So when do you think a 50-year mortgage term could make sense, and to who? All right, so a 50-year mortgage could make sense if you actually have a temporary income problem. Like I said, life is a little tougher. Things change. We have so many things going on, people losing their jobs. So if you already are in the process of buying a house and stuff like that happen, and you say, I really don't just want to walk away, I really want to own a house. Can you do this? So to stretch so that you can actually have your income or whatever you're earning at that time qualify you for a home? Of course you can. Just keep in mind that you shouldn't want to do this for a long time, because you can actually try to refinance at a later date. Okay, if you if you know that you're going to be having an income increase, okay, the people that actually know that in the next couple of months, the next couple of years, I'm going to be having an increase in my income. So why not? If you start with that low payment, you can actually at a later date be paying for it higher. All right, once your income increase, you can increase your payments. That way you can be able to bring down your principal and thereby finishing your loan term earlier than expected. And if you know that I have other things that I'm working on, or I have a lot of debt and I really still want a house, but I want to be able to qualify for the lowest payments possible, lenders can be willing to work with you, but just know that it's a little risky. Okay, but is it a reason why maybe people might want to get into a 50 years mortgage term? Absolutely. And if you think that maybe you don't want to start with a starter home, you really just want to go in straight up to a high-end cost market, or these high beautiful houses, and just go buy your house once and for all and just keep paying to your retirement or whatever. If that's what you choose, I mean, it's still some people's options, right? Not everybody will like a starter home, not everybody will like a low home. So if your goal is to get a extremely high cost home in a high market, why not? You can let your lenders know that you're okay with the stretch of the mortgage and you're fine with it. I mean, it's not everything that will make sense to me that will make sense to you. People have their different options out there, okay, and they have their opinions. And just because 30 years fits someone else doesn't mean that automatically fits the next person. All right, so what are some smarter alternatives to a 50-year mortgage? There are so many options out there. We don't just pay attention to them, but you could still choose. I mean, I'm sure there are some lenders that could choose. They can give you might be something lower than 50, might be 40. If you really can qualify for 50 years, they can go out of their way to give you a 40-year. You just have to ask. And remember, If you don't ask, you will know, right? So you just have to ask. Maybe somebody is willing to give you 40 years. 40 years is high, you're still going to pay high interest, but you're going to pay interest lower than a 50-year term and a little higher than a 30-year term. So you're somewhere in between. It's not so bad as a 50-year also. That could be another alternative if you really can qualify for a 15 or a 30-year. Okay, yeah. And if you equally think that you want to have a shorter loan, a shorter term than 50 years, that's another alternative. Okay, interest only loans, but please keep in mind that these should only be gotten into if you truly understand what it is. If you don't understand, if you don't have any lawyers or any mortgage advisors to tell you what it is, please don't get yourself into it, because you're going to surely pay dearly for it. Okay, so if you can, you had better stick to your 50 years, or yeah, I mean, like, yeah, don't get into the interest only loans if you really can't understand what it is. You can equally buy a house way lesser than what you want to buy at the moment, and then maybe make some equity from that house, and then use that equity to buy the high-end house you actually been wanting. So you buy a less house, you pay it for some years, you make equity, you can sell it, and then you can move. All right, so that's another alternative. I mean, you don't have to start outright with a high-end house or something so expensive. You can start small, and then you can actually move to achieve that goal of yours, because it's possible. You just have to be patient. All right, and you can equally increase your down payments. There are a lot of people that want this lower payment. They equally have that cash that they can actually pay high on their down payment. So if you have money to pay a lot on your down payment, why not? You can still afford that house, have this lower monthly payments, and you know, and you don't have to feel the pain of paying a lot of interest, because remember that the more your principal goes down, the more equity you get, and that means that you're going to be paying less interest as the years go by, because if you're bringing down your principal, they will always calculate your interest from how much is left to be paid off. So if you pay a high down payment, that means you're paying a lot more upfront principal, so you're going to definitely have your interest shrink. All right, so keep that in mind. And number 5 is you can actually make prepayments on principal. So this is like you making monthly payment extra, like maybe $50, $100, $200, depending on how much you have. Okay, so if your mortgage ends up with $1,500 and you have extra $50, you can pay them. Remember, always tell them that this extra money is going toward my principal. So if you are paying toward that principal every month, is definitely going to be helping you bring down your principal. $50 might sound like it's small, but it's not, especially by the time you see 1 year goes by, 2 years go by, you're going to actually keep seeing that money come down little by little, and that way you're going to finish quickly and equally save on interest. And the last option could be you just renting for the moment. It's not necessarily a bad thing to rent. So you can rent and take that time that you're renting to save well. Keep the money, pay down the credit cards, pay down your loans, and have a lot of money. By the time you're willing to go out there to buy that house, you have a lot of money available to either pay down or to afford this house. Okay, so that's the other thing you can actually do at that moment, rather than just jumping into a 50-year-old mortgage term. All right, so let's just recap some key takeaways for this video, which are going to be: remember that a 50-year-old mortgage is going to give you lower payments today, but much higher cost tomorrow. You could be adding about 200 to 350k on interest over the year, the term of the loan. All right, equity is going to grow extremely slow, so equally bear that. Know that if you really want your equity, you're going to be taking a lot of time to realize it grow. The fourth or the fifth is it's very risky. It's a risky investment to get into. It's risky if the home value drops, so bear that in mind. And this could be a trap for debts in a lifetime. So this could trap you and you have to be going through a lot of this. Okay, and alternatives that exist is for you to save money in a long term. All right, so if this video was helpful for you, please like and share to some people. There are a lot of people that will want to know about this. And thank you for watching. Remember, my videos are for educational purposes only. Do your own research and stay safe and healthy. Until next time.